what has been really important and what we talked about the last time I was on your show, right, is that there's this shift in sentiment where the market is getting concerned about U.S. fiscal policy, right? We've been through a multi-decade run where actually the market liked fiscal expansion. When we had stimulative budgets in the past, you typically have growth-sensitive assets liked it, and the dollar liked it. So what is happening here in the last couple of months is a real break where you're seeing the long end of the U.S. bond market sell off. Concerns about the budget is certainly a part of that sell-off, right? And the dollar does not like it. So that tells you we reached a kind of tipping point, right, where the budget concerns is certainly one big part of the instability in the long end of the bond market, and the rising yields that we have seen in the long end have not supported the dollar at all. So this is a huge break in correlations and something that's important. And in terms of the budget, in a couple of hours, I'm going to go from New York to D.C. and have a number of meetings with people who are familiar with the budget process. And this is a crucial time. In terms of my investor base around the world, clients of Exante Data, right, the budget is one of the key sources of uncertainty, something that they need to be hyper-focused on. This is new. It didn't used to be the case that the regular U.S. budget process is something that's making bond investors and currency traders nervous, right? So yeah, we are really at a new juncture here.
Jens, you know, Jim Caron over at Morgan Stanley Investment Management, we talked to him earlier this morning, and he was saying, look, what people seem to be missing is, yes, there are risks with the higher deficit and with piling up more debt, et cetera, right? But you cut taxes, more fiscal spending, et cetera. The whole idea is to try and grow the U.S. economy out of its debt and deficit problems. Is that too optimistic?
I think we have a lot of experience with that in the United States, right, where we have delivered tax cuts, and certain economists have very optimistic views as to how much growth that's going to deliver. And I think often those sort of hopes for very elevated growth on the back of tax cuts have been disappointed. And the explanation is, I think, relatively simple. If you do tax cuts that benefit the high end of the income distribution, they just don't have that big of a propensity to consume, right? So if you give a very wealthy person a tax cut, they don't spend that much extra. So I think that's the source of disappointment that often happens on that front. And what you've seen in the U.S. is that revenue to GDP is going dramatically lower over the last couple of years, starting especially with the Trump tax cuts in 2017, right? So the budget problems that you have in the United States are coming both from the revenue side and the expenditure side, and probably a solution will have to require some measures on both sides as well. And the tariffs is, in a way, the solution that is being proposed by this administration, right? That we're going to have some extra revenue that's going to come in from the tariffs, which is absolutely needed to stabilize budget deficits. The question is, okay, how's that going to impact growth? That's probably going to be a growth drag as well, because that's actually going to be typically spent by and paid for by the consumers.
So, Jens, here's the thing. I mean, this whole thing is going to play out over the next 4, 5, 6, 7 years, for all I know, right? But, you know, real money accounts, institutional investors, I mean, we've seen the specs sell out of dollar already, right? Real money accounts, institutional investors, they haven't actually started selling en masse yet, but they could.
Sure. Yeah. So we speak to chief investment officers all around the world every day, right? And that could be in Asia, it could be in Europe, it could be in Canada. Like foreign investors that have big exposures to the United States, they're the ones that are nervous now. And what often happens when you have a big shock like the one we've seen this year, people really being surprised by the policy direction, the FX hedging is what often moves first. So you trim some dollar exposure by putting on currency hedges, and then afterwards you adjust the actual asset allocation, sell the underlying bonds, sell the underlying equities. So I think the feedback we're getting from our chief investment officer network is pretty consistent, that there's been some FX hedging done, but the actual selling of assets is something that's going to be a multi-month, maybe multi-quarter process, and therefore much, much further to run.